When one door closes, another opens. But we often look so regretfully upon the closed door that we don't see the one that has opened for us. Alexander Graham Bell. Well, hey there. Welcome to the Retirement Answer Man Show. My name is Roger Whitney. I am your host, and this is the show dedicated to not just surviving retirement, but having the confidence because you're doing the work intentionally to lean in and really rock retirement. I love that quote from Alexander Graham Bell. I was thinking about last week's discussion on triage for getting laid off. When a door closes, sometimes rather abruptly, that really rocks your world. Every time a door closes, another opens, and it's so easy to look back regretfully at what you lost rather than look forward and say, okay, let's bring it on. What can we create here? Studies have shown that we value things that we possess much more than they're really worth in a lot of ways. We overvalue things that we possess and we attach more value to them. And that's true with work. When we lose something, we look back regretfully, as it is with material things. I'm in this season where I'm decluttering material possessions. Clothes as an example. Recently, I purchased 7 shirts that are identical. Same exact shirt. I changed some of the colors up. And I am throwing away or giving away perfectly good clothes that were part of my wardrobe that I've collected over the years, some of them not that long ago. I'm trying to get very simple in what I wear every day. Not just, one, it helps simplify decisions for sure, but I want to not worry as much about my clothing options and my possessions, in this domain, clothes. And it is hard to throw away perfectly good clothes that are very nice because there's always a reason. I own them. I put a value on them a little bit more than I should. And this is part of what I'm working against. I wear pretty much the same thing every day. And just take that out of the equation of my possessions, but also out of my mindset so I can focus on you and on creating a great life. That's where it's at. So just some thoughts for the day. Roger's thoughts for the day. Couple of announcements. We have the Rock Retirement Club opening up on May 11th. You can go to livewithroger.com. We're going to have a couple open houses for you to join in, and I'll explain what the club can help you accomplish and let you ask your questions. It's really just going to be a time to come on in and have a chat about it and see if it's a good fit for you in order for you to rock retirement. So we're excited about that. And today we're going to continue to focus on you and your retirement questions. So why don't we go do that? Got some great questions lined up for today. If you have a question for the show, you can go to rogerwhitney.com/ask Roger. And you can type in your question, or you can leave an audio question if you desire, and we'll try to get it on the show and focus on you and the issue that you're dealing with. So our first question comes from Jim in regards to where to store his safe bucket. Jim says, hey, Roger, great show. Listen to all the episodes. I have a simple question. I just retired and have about 3 years worth of expenses and some fund money that are in money markets and credit union savings. I'd like to bridge about 3 years before I reach full retirement age for Social Security, and this money will cover that. And I'd like to keep these 3 years of funding in fairly safe liquid assets, i.e. cash or CDs, and then maybe 3 more years in a reasonably safe investment. However, with CD rates where they are now, or even short-term treasuries, I can lock in pretty good returns and keep my money safe. Jim says, I hear a lot of advice about utilizing bond funds for 2 to 6 years. So 2 years of cash, say, 3 to 4 years in bond funds. I'm not sure I see the advantage to this approach. Bond funds all took a beating here in the last 18 months as interest rates increased, he says. And I can lock in over 4% safely for those years and not have to think about it anymore. What are your thoughts regarding using bond funds, even short-term bond funds with durations of 3 years or less? Is that better instead of cash? What would be the advantage? That's a great question, Jim. So let's break this down and give you a way of thinking about this. So it's already a given that you're going to keep 3 years in quote unquote liquid assets, CDs, treasuries, or money market and savings accounts. You're asking about the next 3 years, years 4 through 6. What do you do with those monies if you want to have essentially a 6-year income floor? As you noted, we've been in this shifting environment in terms of interest rates. A little over a year ago, interest rates were zero, CD rates and bond fund rates were not that attractive, and everybody was searching just to try to get some kind of yield. And bond funds, even short-term bond funds, was a place where a lot of people were looking. Now, fast forward the 18 months that you talk about, and interest rates have come up significantly, which has changed the game for everything. And those short-term bond funds, even the ones with a duration of 3 years or less, have actually lost money over the last 12 to 18 months because the value of the funds have gone down because interest rates are higher and bond prices move inversely to interest rates. Now, this term you use, duration, Jim, just so everybody understands what that means, is essentially the average weight of the maturity within the portfolio. So as an example, a bond fund with a duration of 3 means that the average maturity, even including the interest payments, is about 3 years. And the reason that number is important when you're gauging potential risks with a bond fund, mutual fund in this instance, is that the rule of thumb is that for every 1% movement in interest rates, the value of the bond mutual fund will move up and down inversely related to interest rates. So as an example, if interest rates go up by 1%, the rule of thumb is that a bond fund with a duration of 3 years would go down by 3%. Just like if interest rates went down right now by 1%, mutual fund with a duration of 3 years would move up by 3%. So it's a gauge of the volatility of a bond fund. What you decide to do, CDs, treasuries, money markets, has a little bit to do with your opinion on where interest rates are going to go from here. If you believe that interest rates will go higher, then purchasing money markets or short-term treasuries would make sense because that money would come due in a shorter period of time and then you could reinvest at the higher rates. Conversely, if you thought interest rates were going to go down from here, then you would want to lock in maturities a little bit longer. You'd want to lock in year 4, year 5, and year 6 in, say, a CD or even a bond fund because you think interest rates are going to go down. Whatever you think is going to happen is probably going to be different than what really happens. My rule of thumb with this, Jim, is not to use bond funds for the income floor between 5 to 6 years, even out to 7 or 8 years. The return of your money, even in year 4, 5, and 6, is more important than the return on your money. Ergo, I would not recommend that you look at trying to perhaps capture a higher yield in a even short-term bond fund. I would look at how can I get a reasonable return on my money, whether that's a 3, 4, 5, 6-year treasury or a corporate bond or CDs, and just lock in the return that you're going to get in the terms of the interest rate. Have guarantee and clarity that you will get your dollars back upon maturity, and then not make it any more complicated. When you're looking at monies that you're investing longer than this income floor end of it, Jim, then you can look at bond funds because you're just trying to get an aggregate asset allocation. And the time frame is such, in theory, that whatever cycles we're in, whether it's interest rates, bear market, or bull market, statistically, you're setting yourself up for success. So I'm not a big fan of reaching for yield and using short-term bond funds if it's money that you're going to need, even if it's 4 or 5 or 6 years out. Our next question comes from MC related to QCD. So I'll read the question and we'll talk about what it is. Recently discovered your podcast. Thank you so much. My question is regarding QCDs. Have the rules for QCDs changed for 2022 and 23? Both Schwab and Vanguard have issued 1099 showing QCDs as taxable income. When asked about the change versus the 1099s in 2021, the answer seems to be a version of, well, that's how we do it now, and it's your responsibility to provide documentation to your CPA, blah, blah, blah. you need to document that the checks were actually sent to a charity rather than to me, and they're not really taxable income. This system discourages donations, and I understand exactly what you mean, MC. So let's talk about what MC is talking about first. If you are 70 and a half or older, you can make a qualified charitable distribution from your IRAs or your 401k in the form of a charitable contribution, and the check is written directly from your tax-deferred account to the charity in question. You can actually do multiple distributions as charitable gifts from your IRA. You can do up to $100,000 per year if you're over 70 and a half. And any QCD, qualified charitable distribution you make going directly to a 501c3, a qualified charity, counts towards your required minimum distribution. And there's been a lot of changes to your required minimum distributions, your RMD, here in the last few years. First, it went to 72. Now it's 73 or 75, depending on the year that you are turning or the year that you were born. But the rule for qualified charitable distributions has not changed. It's still 70 and a half. In fact, I'm doing one for a client that's 70 and a half right now. We've been waiting for this time. And the process for doing a qualified charitable distribution is you're working with your custodian. In this case, MC is talking about Schwab and Vanguard, but any custodian, financial firm. You don't just take a distribution and then give the money to charity. There's a process for this that you have to follow. And each of these financial firms will have their own form. You give them the information for the charity, and they send the amount that you want to give to the charity from your IRA directly to that charitable institution. So it never goes into your hands. And that qualifies for covering your required minimum distributions, and it's not a taxable event because it's going directly to a charity. So it's a good way to give, but also to not have to pay taxes on income as a result of RMDs. So what MC is talking about is every year when you take distributions from an IRA, you receive a 1099R, a 1099R showing the distributions from your IRA. And this is where it can get confusing. And it's not just simply with QCDs. It can be with a Roth conversion. It will show things in weird ways that can be confusing. In this case, what MC is saying is that he received a 1099R and it showed the amount of the qualified charitable distribution as a taxable distribution on that tax form. And in your mind, you're like, hey, wait a second, this isn't taxable because it was a QCD. You made me fill out a special form. These custodians have their standard operating procedures and just how they report things, and it can be annoying at times. So what do you do with that? What you can do is, rather than argue with a big organization that's not going to change their policies for you, is you can document the fact that you gave this as a QCD to the charity at hand. So you want to make sure you get an acknowledgement in writing that shows how much the charitable contribution was, whether you received any goods or services in exchange, and it should show the date of the contribution. So you want to have all of this in writing, acknowledging the charitable contribution that they received, and you have the statements. And then when you go to do your taxes, then in the 1040, you're going to identify a portion or all of that distribution from the 1099R that you receive from the financial firm as a qualified charitable distribution. And that's where you're going to have the offset, so you're not actually paying taxes on the distribution that went to the charity. Yes, it could be easier, but we're dealing with huge bureaucracies, not just the IRS, but individual large financial firms, in MC's case, multiple financial firms, and they all make their decisions of how they do things for reasons that you and I just don't understand at times. So just make sure you get written acknowledgement showing those items. And then when you're doing your taxes, make sure you inform your CPA that, hey, yeah, I got the 1099 that shows this, but here's the documentation that this went to a charity via the process, so you can have that offset. So our next question comes from Mary in regards to Roth IRAs. Mary asks, does the IRS define 1099 wages as earned income? Specifically, Mary wants to know, if a taxpayer only has 1099 wages in a year, no W-2, can the taxpayer contribute to a Roth IRA? It's a great question, Mary, and it depends on the type of 1099 that you're talking about. If you mean someone with earned non-employee compensation, that would be a 1099 NEC, non-employee compensation, say for a business that you own. And if you're contracting and paid via 1099, that's essentially you owning a business. Then for sure, that is considered earned income, and you could make Roth IRA contributions, or you could even establish your own small company plan if you have regular income in that form. But if you mean a 1099-R, distributions from, say, a retirement account, then no, that type of income is not eligible in terms of meeting the income requirement in order to make a Roth IRA contribution. So the rule of thumb there is it has to be income reported as 1099 that's actually income from work. All right, our next question is actually a comment question from Teresa on the March episode we did on going from 2 to 1. Teresa says, "Hey, Roger, I've been listening for about a year and have learned so much from your show." Oh, that's awesome. And Teresa wants to make sure that at some point we cover not just going from 2 to 1 because you lose a spouse, say, to death, but going from 2 to 1 because of divorce and separation. And that's a great point, Teresa. And you share your story. I read your story that you shared with me. No one ever expects this to happen later in life. And gray divorce or divorce is a big issue. It's a devastating issue for many people at any time, but definitely later in life. And yes, when we thought about going from 2 to 1, initially we were going to incorporate both, losing a spouse to death or divorce. And we decided that although they have some similarities, there's more there that needs to be done separate. And as you shared in the story with me, there's a lot more implications and considerations that come from a divorce that are just different. And so we do plan on covering that topic in the future. I want to thank you for sharing your story. And although we didn't take it on in March, we are going to take it on as a specific theme. So stay tuned for that. Our next question comes from Al related to the ordering of taking money, specifically to decumulation. And Al was kind enough to leave us an audio question.
Roger, I've been a listener to your podcast for several years and have really enjoyed your down-to-earth explanations and advocacy for your listeners to rock retirement. I have a question about withdrawal sequence. I will retire at the end of 2023. I have a feasible plan of record, and I am working on resilience and optimization. Traditional advice recommends utilizing after-tax assets first, tax-deferred assets next, and tax-free assets last as a sequence. I have a six-figure 457 deferred comp asset with my employer, a large, stable healthcare organization, so no worries about default. Employer rules dictate the account remain with the employer, so no rollover option possible. And retirement distribution options are limited to a lump sum distribution or an annuitized distribution over a number of years of my choosing. I feel that I want to access this early in retirement since it technically is only a promise of payment, even though it is a tax-deferred asset. And I will have several years of after-tax assets still available. Just wanted to get your thoughts. Again, enjoy your show tremendously. Keep doing what you're doing.
Great question, Al. And thank you so much for listening to the show and letting me be a small part of your journey on rocking retirement. So Al's question is, where do I pull from first? And I have this special asset, this 457 plan. Well, you're exactly right. The default assumption in retirement planning is that you drain all of your after-tax assets first, those bank accounts, etc., before you touch your tax-deferred assets, IRAs and traditional 401ks. That is a simplifying assumption that rarely is the right answer. That comes from spreadsheets in what makes sense from a mathematical formula over a very long period of time with a lot of simplifying assumptions built into those spreadsheets. And your retirement's a lot more than a spreadsheet, as we know. And there's a lot more nuance to this answer. It's awesome that you have a feasible plan. That's critical. Now you have a home base to create what-if scenarios on how to make it resilient and then ultimately how to optimize it. And I would say this is primarily, you're right, in both of those categories, probably more on the optimization stage from a tax management standpoint. You want to begin this journey from home base, Al, in asking yourself and then getting clarity on the answer, what am I trying to solve for? In making this decision of where I'm going to draw assets from the different tax categories, what am I trying to solve for? Am I trying to solve for reducing my required minimum distributions later in life? Am I trying to solve for staying below Medicare IRMA surcharges or taxation of Social Security? Am I trying to solve for leaving as much money as I can to my heirs? Am I trying to solve for delaying Social Security for as long as possible so I get a higher benefit of secure social capital? Understanding what you're trying to solve for is going to help you find your pathway best, because each one of those will lead to a different decision. Since you have home base, this feasible plan of record, using the traditional simplifying assumption of draining your after-tax accounts first, etc., you can forecast where you should be from a tax bracket standpoint, at least over the next 5 years with some clarity. And then you can start to create what-if scenarios. You go to first base, and let me test this out. What if I turn on my 457 to pay me income so I can solve for filling the income gap to pay for my life so I can delay Social Security? Let me map that out and test it and see how that looks. And then you build that model, that cash flow model, to see how that impacts your taxable income in a year-by-year basis. What if I take it as a lump sum today, really get hit 1 year with high tax brackets, perhaps IRMA surcharges on Medicare, etc., but now I have even more after-tax assets that I can use to supplement life and or give away or spend, and that allows my tax-free assets to grow further. You get the idea. I can't really give you the answer because I don't know what you're trying to solve for. Maybe you're going to work in QCDs, qualified charitable distributions, as part of this strategy. But the fact that you have this home feasible plan of record makes everything a lot easier, Al, so you can test these one by one and get to the decision with the 457 of how you actually structure their withdrawals. Some ways that I've seen it done successfully are in creating a series of payments over a specific time. A good example here is I have one gentleman who I know that retired at 59, and he structured his series of payments to come out over 10 years, which is allowing him to preserve his after-tax assets, stay in a reasonable tax bracket, and delay Social Security for as long as possible. And that basically filled the gap, because this 457 plan, like most of these type of structures, are deferred compensation. So you're realizing the compensation now to replace the compensation that you just gave away after retiring. So that's one that I've seen that's been very successful. But the key is just iterate, Al. You're going to get to the point. You're not going to get it wrong. You're not going to get it right. You're just going to have to make a judgment call, but you're already in a position to make a really thoughtful judgment. And hopefully this helps you on that journey. The next listener that wanted to share is Jim and Karen regarding passwords and after somebody passes.
Hey, Roger. During one of my trips on your Wayback Machine, I was reviewing episode 50 about leaving a mess when you die, estate planning. During that episode, you recommended creating an ICE document that contains all your information with your financial, social media, and email accounts, along with your passwords. My question is, with today's ever-changing online environment, I find myself constantly updating my user logins and passwords. Is there an easier way to update this information and make it accessible to my surviving family members when it's needed the most? It just seems that pen and pencil is so outdated nowadays. Thanks again. We really enjoy your podcast. Jim and Karen.
Hey, Jim and Karen. Wow, you did go in the Wayback Machine. Episode 50. We're on 481 today. We just had our 9th year anniversary last month. I'm glad that even something that far back was so helpful. Good point. Now, we talked about creating an in case of emergency binder, which is sort of the old school way of doing it, which is very comfortable for our vintage of human. But as you point out, Jim and Karen, hey, there's a lot more digital stuff going on that can get very complicated, and having to change passwords every 90 days on all sorts of financial accounts. And I do think there is a better way. And for me, that way is using a password manager, a digital password manager. I use 1Password. I've used it for years. LastPass is another password manager. Apple has its own built-in one. I like those structures because they allow me to dynamically update the password in the manager as I have to update it on whatever website I'm logging into. In my case, I use 1Password. And when I change a password, it asks me, do you want to update the password in our records? I like it for that reason. I also like it for another reason, Jim and Karen, is that all of my passwords are much more complex as a result, because these password managers, these digital password managers, have a password generator of these strings of 18 to numbers and symbols and letters and all sorts of things. So I literally don't know the password to most of my accounts because it's kept in 1Password in my instance. And when I go to that website, it will automatically fill the username and password for me in that particular site. So that ends up meaning that I have much more robust passwords that are different for all the different sites I go to, which helps me from a security standpoint. And 1Password, LastPass, and I'm sure there are some others. One of the potential downside for this is that all of this data is going to be held at the service, and they are at risk of being hacked just like anybody else is. Years back, and we did an episode on it when Equifax was hacked. If Equifax, the large credit bureau, can be hacked and the government can be hacked, pretty much anybody can be from time to time. So there's a risk there. You could say the same thing for paper. Now, with these password managers, generally they have the master password. Like 1Password has one password that lets you into the kingdom of all the other passwords. And you better remember that 1Password. So as a result, from in case of emergency planning standpoint, you have to have some place where that 1Password, the keys to the kingdom, is, that your spouse or the children or so forth can have access to it to access this. The way that I like to do that, I use a digital in case of emergency plan now. I use Everplan, which is an online in case of emergency portal that acts a lot like TurboTax. It will interview you and it helps make sure that you have it complete. And we actually have that as a free benefit for club members because I think it's so important. And within a digital structure like that, you can assign deputies, meaning that my password to my 1Password is logged in my Everplan, my digital in case of emergency plan. And then my son, Spencer, he can get access to it only under certain circumstances. You can manage those circumstances. If Roger dies, then Spencer gets everything, or this deputy gets everything. So I do think there's much more eloquent ways than paper and pen, although that is probably the most comfortable thing for us. With that, let's move on to the Bring It On segment. Welcome to the Bring It On segment, where you are the hero that you've been waiting for. Today, we are going to talk about mindset. The question I want to ask you is, are you ever enough? Do you ever have enough? Are you ever fully complete? Literally, every time I'm done recording this podcast, this is an example. We had just had the 9th anniversary of the show, and I give it to the editor. I walk away saying, dang it, that could have been better. I could have been more articulate. I said so too much. I didn't finish my sentence. I beat myself a lot. I need to be better. I need to be better. Recently, I learned a reframing that I want to challenge you to adopt in your life. Generally, reframe things as, I need to be better. I need to do better. I need to get better stuff. The stuff I have isn't good enough. I need better stuff. I need to get better friends. I need better opportunities. I need to build a better retirement plan. This type of reframing is a loser's game. It implies that you are not enough, that you don't have enough, that you are lacking in some way. It's a never-ending cycle that frames you and your life as incomplete. That's not healthy mentally or financially. I need better returns. I need better investments. Reframing it with, I need better, or I need to do better, isn't healthy. So I say that we get off the better bus and we get on the best bus. Because I'm going to remind you, which I have to remind myself all the time, is like, dude, you are only human. You're only human, and you have different levels of energy and attention, moment by moment, day by day. All you can do in any moment is your best and give all you've got. Being on the best bus stops the cycle of constantly putting yourself and your situation down. You don't need to be more than who you are. You just need to focus on being your best self more often. You don't need a better house, cars, clothes, spouse, spreadsheet. You and what you have is enough. Now just do your best in this moment. This reframing from the better bus to the best bus stops putting ourselves down, sort of frees us to be able, okay, I got to do my best. And when you do make a mistake, and you will, just look at it and say, oh, okay, that needs work. That needs work. And it will stop the cycle of beating ourselves down as if we're not enough. So I'm going to challenge you to start thinking about just doing your best with who you are. And don't worry about doing better.
On your marks, get set.
And we're off to create a little baby step we can take in the next 7 days to not just rock retirement, but to rock life. All right, in the next 7 days, why don't you confirm with your spouse that they know how to access the passwords for the things that are important? Just ask them a question. This will take 2 seconds. And that will identify either potential areas to work on or give you confidence. Okay, I checked that box. We create this show for you to empower you to rock retirement. We want to do this with focus. I always want to be focused on you and your journey and help you have hope for the future. I think you can totally do this. We want to do this in an authentic way. No pretense. We want to be humble. We want to be respectful on every topic that we hit on. And you and I, we got to continue to be curious and look at things with fresh eyes, just like Jim and Karen did on the password and ICE plan. And we want to hold our beliefs up for examination to either confirm them or amend them. And we are always going to be free from big finance and financial products that taint a lot of the information that we get. We're just like you, trying to figure this out and create a great life. We're not going to talk about products for money. We're not going to use gimmicks on you. And we're going to be focused on you taking incremental action or expanding your perspective. I am all in on helping empower you rock retirement. So let's go do this. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.